Welcome to Trading Nation. I'm Eric Chemi, joined by Paul Ciana, Chief Technical Strategist with Bank of America Merrill Lynch. And Paul, you're looking at an interesting pattern in the chart of the 5-year Treasury bond yields. Talk to us a little bit about what you're finding out here on the charts.
Absolutely. Pleasure to be here, Eric. Thanks for having me.
You got it.
In 5-year Treasury yields, it's been an interesting week because heading into the start of the week, not only 5 years, but 2s and 10-year Treasury yields were forming head and shoulder top patterns. Most of them were at the top of the right shoulder or starting to roll over a little bit, suggesting that there could be a bit of a decline here in U.S. yields. Now, this week in particular was very active as markets kind of whipsawed around a bit. And what happened earlier on in the week is 5-year yields continued to fall and actually broke an important level of 1.84% on that 5-year Treasury yield chart. And Eric, that was a very important level because that represents the neckline of a head and shoulders top pattern in the Treasury yield market there.
So what happened though? Because I feel like after the election, everybody was saying, look at these policies, yields are definitely going to go higher. And then all of a sudden, everyone I know, they're out trying to buy a house because they feel like I got to lock in the rate now before it takes off. And then you look at these charts and you're telling me, no, this is not a good time to do that. Yields are coming back down. What happened here?
Sure, exactly. So there's the tide, the ripple, and the waves in the markets, right? Right now what we're looking at in these daily charts suggests that at some point in Q1 that U.S. Treasury yields will fall and correct some of that massive move that we saw in Q4 of last year. Now, our house call and my technical call is that U.S. 5-year Treasury yields could get up to about 2.35% this year. However, inside of that move, there's always at least a correction, possibly two, and we think that this is darn near close to one of them as 5-year Treasury yields did fall below that key level and that neckline.
So you talk about 2.35% on the 5-year, but then I think from your note, you thought it could hit as low as 1.5%. That's a huge range if it looks like you're getting to 1.5 before you're getting to 2.35.
That's correct. So when we look at the head and shoulders pattern, one of the things as a technician we like to do is try to estimate some targets where yields or a market could fall to, like using this head and shoulders. The height of that head actually measures down a max target from that breakdown point in the neckline to 1.5%. So that would be a full 100% move and a little aggressive, sure. That's why we also highlighted the 61.8% projection as more likely at about 1.65%. And given how things did go this week, after the tweet from POTUS on Wednesday or Thursday and the whipsaw that we saw, less of a decline in U.S. Treasury yields at this point is more likely, such as 1.65%. The rebound on Thursday and some of the whipsawing today does bring back some additional reason to believe that we could still fall or that we could actually just resume higher. So we're watching very closely, Eric, a particular level. That's the 50-day moving average at about 1.93%. If we see 5-year yields lift through that over the next couple of days, this pattern is likely over.
So here's the thing. When I think about an end-of-year target or a 12-month target, obviously, in your position, people are thinking about those numbers. But my real question is, how confident can anybody in your shoes even be at where the world's going to be a year from now? That's the real question, right? Is how little confidence we have in whatever direction this is going in, right?
Yeah. Confidence is an issue in the short term and also in intermediate to longer term. Just this week, the number of times like the U.S. dollar went up and down every day, right? Treasury markets kind of did the same thing. We see a lot of short-term whipsaws, so we have to look at the breadth of the market. There's head and shoulder tops in the Bloomberg Dollar Index that's bearish for the USD in the near term. There's head and shoulder tops in the 2s, 5s, and 10s like we were saying. 30-year almost formed it. We see head and shoulders in the 2s, 10s. It was about 15 different charts that we called Trump-inspired head and shoulder tops that formed or were forming this week. So that's a big picture there, looking across a lot of different markets to suggest that there may be another correction of these Trump trends here in Q1.
Trump-inspired head and shoulder tops. I like it. Paul Ciana from Bank of America Merrill Lynch. Thanks for joining us here.
Thank you, Eric.
And thank you for joining us on Trading Nation. I'm Eric Chemi. We'll catch you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.